Welcome everyone, and thank you for tuning in to hear my trading and market updates. This is Uncle Frank, and I'm not a financial advisor, nor is any of the content to be construed as financial advice. This channel is for entertainment purposes only. Please remember to hit the like button if you enjoyed the presentation, and be sure to subscribe to the channel so you're alerted when I have new information to share. So now let's get into the latest updates. Hey, welcome back everyone. Now, if I were a predatory short hedge fund and I was over my skis on a short trade, or to put it another way, if I were forced to cover, it would be a catastrophic event. Let me tell you what I'd want. I'd want you to convert APE into AMC. Then I would have millions of freshly minted AMC to cover with. I would want you to mass dilute it as opposed to selling a little at a time so I could buy it even cheaper. Then I would love a reverse split so I could cover for pennies on the dollar after I drive it into the dirt again. And the best part is the reverse split would conceal my crime by eliminating any synthetic shares, if they exist, of course. Adam says there's no such thing. So let's review who exactly designed this plan, beginning with the alleged rig vote, conversion, mass dilution, and reverse split. This slide depicts the team that Adam Aaron put together to handle all of that, which resulted in a class action lawsuit in Delaware. Now, the yes voters are mad at the no voters because this all went sideways. But shouldn't they be mad at whomever designed this plan and didn't research to see if it was all legal? I mean, they call it a frivolous lawsuit every day, but you don't settle frivolous lawsuits for $130 million. So let's start at the top with the leader of our board of directors, Philip Lader, senior advisor to Morgan Stanley Institutional Trading, with a daughter that's in senior management over at Uniswap, where AMC tokenized securities were found to be trading. He hasn't bought a single share of AMC over the past 5 years, but sold out near the top. By the close of last year, Morgan Stanley had about $123 billion in securities sold yet not purchased. I want you to know Adam went out of his way to add Phil to the APE Conversion Pricing Committee. And then there's CITI, our own investment banker, the actual underwriter of APE, a short seller of AMC, a company with a sell recommendation on AMC from this very month with a price target of $1.65. As of the close of 2022, CITI had about $183 billion in securities sold under agreements to repurchase. We should just hire Credit Suisse or Citadel to handle this deal for us. And then there's Antara Capital, the guys we gave APE to for 65 cents that sell 1 to 3 million APE every day. They're facing federal securities litigation seeking the return of its alleged short swing profits. The lawsuit filed by 2 AMC investors accuses the hedge fund, its affiliates, and founder, Himanshu Gulati, of making more than $20 million on sales of APE units and AMC common stock purchased less than 6 months earlier. Federal securities laws require corporate leaders and major stockholders to give such short swing profits back to the company, a rule meant to curb insider trading. Now Antara was launched back in 2018 with money from Blackstone. Those were the guys that back in 2015, along with KKR and TPG Capital, agreed to pay $325 million each, I believe, to settle litigation alleging they colluded to keep leverage buyout prices low. Let me say that again. The guys backing Antara were sued for keeping stock prices low. Anyway, earlier this year, Blackstone admitted it was also part of the SEC's texting sweep case. Last month, the law firm Scott & Scott is investigating whether members of Blackstone's board of directors or senior management failed to manage Blackstone in an acceptable manner in breach of their fiduciary duties to Blackstone, and whether Blackstone and its shareholders suffered damages as a result. Antara is, of course, also listed as a current short seller of AMC, and many apes believe that Adam Aaron may have colluded with Antara to rig the recent shareholder vote. So let's review who Phil for Real and everyone else trusts on this scheme. Adam Aaron and 2 known short sellers of AMC, CITI, and Antara, plus a senior advisor to Morgan Stanley Institutional Trading. All joined to create this scheme, and I'm a shill for not trusting these guys, right? Before we continue, I want to prove that Adam Aron went out of his way to add Philip Lader to the Ape Conversion Pricing Committee. From the document, Mr. Aron indicated it has been the company's tradition to delegate final terms of equity transactions to a pricing committee composed of Mr. Aron, Ms. Paulus, and Mr. Whitlinger. Mr. Aron proposed adding Mr. Lader to the committee in case Mr. Whitlinger needs to recuse himself from decisions on any transactions. The board voted to appoint Mr. Lader to the pricing committee for these purposes. Now, let's take a look at the prime banks and brokers that are our short sellers. Well, we know JP Morgan Chase is because they own 100% of Highbridge. Highbridge, of course, appears on our list of short sellers, along with Bank of America, Citi, Barclays, Antara Capital. But where is Morgan Stanley on this? I'm glad you asked. Now, guys, get comfortable. I need you to stick with me on this. I'm going to prove to you over the next couple slides why it's a bad idea to trust Citi with designing this whole thing, and why it's a bad idea to have Philip Lader of Morgan Stanley leading our board of directors. Go back with me to June of 2021, where the headline appeared in Bloomberg, Wall Street reins in hedge funds short bets on meme stocks. From the article, Wall Street's top brokers are quietly tightening their rules for who could bet against retail traders' most popular meme stocks. Goldman Sachs, Bank of America, Citi, and Jefferies are among the firms that have adjusted their risk controls at prime brokerage operations, according to people familiar with the moves. The banks are trying to protect themselves against fallout from extreme surges and dips that have characterized trading in companies including AMC, Microvision, and GameStop. The changes mean some hedge funds and other institutional investors now face higher collateral requirements or are limited from shorting certain stocks, the people said, asking not to be identified, discussing internal policy decisions. Quote, until further notice, Jefferies Prime Brokerage will no longer offer custody on naked options in GameStop, AMC, and Microvision, the firm said in a memo to clients seen by Bloomberg News. Naked options allow investors to short a stock without owning the underlying securities. Jefferies, which told clients that other stocks may be added to the list, will also no longer permit short sales of those securities. Representatives of Goldman, that's one of our biggest spoofers, Bank of America, one of our short sellers, Citigroup, one of our short sellers, and Jefferies declined to comment. It's not unusual for banks to adjust their risk controls as market conditions change. The measures may change the fortunes of retail investors lighting up Reddit message boards with their forays into day trading. Increased margin requirements could hasten the short squeezes small investors have been rushing in to capitalize on. On the other hand, if hedge funds pull back on short bets due to the new restrictions, the Reddit crowd won't have as many opportunities to chase short squeezes. Now, under the heading Archegos Fallout, here's where it gets interesting. Many brokerage firms have been re-examining their risk controls after some of the industry's largest prime brokers were forced in March to liquidate the multi-billion-dollar portfolio of Bill Wang's Archegos Capital Management at a discount, though Bank of America and Citigroup were among those that escaped the saga unscathed. The little-known family office collapsed after making a series of wrong-way bets on media and technology companies. Quote, fortunately, it didn't hurt taxpayers, it didn't hurt investors, Morgan Stanley Chief Executive Officer James Gorman told lawmakers last month at a House Financial Services Committee hearing. Quote, again, it hurt Mr. Wang and his family office, and it hurt the banks that were prime brokers to him. Morgan Stanley recorded a $900 million loss tied to the ordeal. Morgan Stanley recorded a $900 million loss tied to the ordeal. The origins of the so-called meme stock craze, in which retail investors push seemingly random stocks to dizzying heights, are largely unclear, though some analysts have pinned the trend on the fact that no-fee brokerage apps have proliferated, just as many Americans were flush with savings. AMC became the new king of the meme stocks in recent days. Investors have sent the cinema company shares soaring more than 2,000% this year alone, the good old days. GameStop, the original beneficiary of the frenzy on Reddit boards dedicated to stock investing earlier this year, is up more than 1,000%. It's not just Wall Street that's taking a more cautious stance. Policymakers have also signaled concern over prolific retail trading, especially of options that can multiply the risks. After the GameStop turmoil earlier this year, House Democrats questioned the leader of retail brokerage Robinhood Markets, among others, about profiting at the expense of small investors. Key to some of the debate has been the practice of naked short selling. The strategy allows hedge funds to make bets that exceed the market values of some companies. That's become a signal for small-time investors that there's a potential to profit off of a short squeeze. Stick with me. Okay, so now we know that Morgan Stanley got its clock cleaned in this Archegos thing. But let's fast forward to October of 2022. You all remember Credit Suisse, the 167-year-old bank that was short AMC, had a sell recommendation on us with a price target of 95 cents and then exploded and blamed retail traders. How about this headline from Reuters? Credit Suisse taps RBC Morgan Stanley for capital increase. So now we've got Morgan Stanley loaning money to one of our greatest enemies too. From the article, Credit Suisse is working with banks, including the Royal Bank of Canada and Morgan Stanley, on a potential capital increase should it need to shore up its balance sheet and raise funds for its restructuring, Bloomberg News reported on Tuesday. A capital increase through a possible share sale under the name Project Ghana could come after the bank's formal restructuring announcement on October 27th, the report added. The report said that Credit Suisse, one of Europe's biggest banks, would likely seek at least $2 billion to cover restructuring and any operating losses over the next couple of years as it pivots the business. The Swiss bank is trying to recover from a string of scandals, including losing more than $5 billion from the collapse of investment firm Archegos last year, when it also had to suspend client funds linked to failed financier Greensill. So Morgan lost, $900 million during the meme stock rage just from Archegos, and then loaned billions to Credit Suisse that imploded, and you trust this yo-yo from Morgan, Philip Lader, to be the head of our board of directors? You actually think he's going to choose AMC shareholders over the interest of every major prime bank and broker, including his own? You've got another thing coming. And yes, I'm pleased to report that AMC remains on the New York Stock Exchange list of threshold securities. But don't worry. As you remember, back in March, Adam tweeted, many of you and we are aware that AMC has been on the threshold list for 3+ weeks, indicating a number of FTDs. Some of you may be pleased to learn that we have contacted both FINRA and the New York Stock Exchange, asking that they both look closely at the trading of our stock. Well, Adam, we've been on this list now since June 23rd. I think it's time for another phone call. But I don't believe Adam Aron is really going to make that phone call. In fact, you guys all saw that gap up, that beautiful spike in AMC, followed by one of the best weekends we've ever had since 2019. And what did Adam do? Stop the rally in its tracks with these headlines. AMC warns of bankruptcy amid Barbenheimer's success. AMC CEO talks about possible bankruptcy in the future as stock rallies 34%. What a shame. AMC closed Friday at $4.64, up 2.65%, and the APE finished at $1.80, down 3.23%, bringing the combined price of AMC and APE to $6.44, up 0.94% on 33.4 million shares trading. Now, based on that last price of $4.64, expect support to the downside at levels $4.55, $4.46, and $4.40. To the upside, expect resistance at points $4.70, $4.76, and $4.85. And the corruption returned to the dark pools on Friday. Friday's off-exchange and dark pool volume was 16,093,000 shares, which was 65% of the day's total volume. Only 7.42% of AMC trades were executed on the exchange we're listed on. And of course, I'm still on the lookout for black and white swans. From CNBC, things are going to break. Kevin O'Leary predicts Fed hikes will lead to more U.S. regional bank failures. And from MoneyWise, the whole structure needs to tumble. Black Swan author Nassim Taleb warns that a 2008-style crash could be coming. And then Jeremy Siegel from Wharton, equity markets are headed to new highs, which could be a black swan for short hedge funds. But for now, this is the swan that Uncle Frank is betting on. A headline from the Motley Fool: this leading market indicator has never been wrong. Here's where it says stocks are headed next. From the article, since the start of 2021, the iconic Dow, broad-based S&P 500, and growth-powered NASDAQ composite catapulted to new highs, plummeted into a bear market, and have now bounced back meaningfully from their respective bear market lows set last year. The prevailing question is, what's next for stocks? According to one leading economic indicator that's never been wrong, there's a clear-cut answer. This leading indicator hasn't been wrong in 64 years. What's it called? The Conference Board Leading Economic Index, or LEI. Now guys, the monthly reported LEI is a predictive tool composed of 10 inputs that are designed to recognize turning points in the business cycle by around 7 months. These 10 inputs include financial components such as the interest rate spread, that's the difference in yield between the 10-year Treasury bonds less the federal funds rate, as well as non-financial factors such as private housing building permits and average weekly unemployment claims. Bottom line is it's never been wrong, and last week, July 20th, the Conference Board published the June LEI data, which showed a 15th consecutive month of declines. On an absolute basis, that represents the third longest streak of consecutive monthly declines in the index's history. More importantly, the LEI clocked in with a 4.2% decline over the 6-month period between December 2022 and June 2023, which was a steeper drop than the 3.8% contraction experienced between June 2022 and December of 2022. On an annual basis, the LEI is nearing a decline of close to 8%. When you backtest it to 1959, an annual contraction in the LEI of 4% has always represented that a definite recession will come for the U.S. economy. Period. Hey, I want to thank you for watching, and please remember to hit the like button after this slide if you enjoyed the presentation. Subscribe to the channel and set the alert so you're notified when I have new information to share. See you at the bell.